right, real estate investors, 2026 is coming. We're almost a quarter away. So we're going to talk today about where we're heading for DSCR strategies and opportunities into 2026. So if you've been using DSCR financing or you're just starting to get used to it and you want to learn more about it, you're in the right spot. You're going to want to know the trends, the risks, and the opportunities. So today I'll break down the shifts that I'm seeing jumping into 2026 to make sure that you position yourself to win in the investment space. Now, over the last 5 to 7 years, DSCR loans have exploded in the marketplace. We're seeing a large percentage of overall loan volume directed toward the non-qualified mortgage space or the non-QM space. And a lot of it has to do with DSCR loans. This is because they underwrite the property's ability to generate cash flow, not your personal income. A lot of banks have tight guidelines and the rates are fluctuating. They're getting a little bit better overall, but they still remain very tight and comparable to conventional rates. With slightly higher interest rates and tighter bank guidelines, investors tend to lean on DSCR financing more than ever. And the cool part is more lenders are actually entering the space to offer DSCR type products, and I'm excited to share with you what I think is going to happen as we get into 2026 and beyond. This creates more competition for lenders and it creates more opportunity for you. All right, so here's what's coming in 2026. At least this is my opinion. I don't know if this is true, but this is what I'm seeing. But first, my name is Jeremy. I am a certified mortgage advisor based in Phoenix, Arizona. We work all across the country with investors, we empower realtors, and we consult with homeowners and home buyers to make sure they understand everything they need to understand about financing, creating leverage to help generate wealth both in the near term, midterm, and long term for generations to come. So I thank you for being here. I hope you enjoy the video. So I think the first thought I have for 2026 is that DSCR loans have been commonplace for several years for single family homes. Okay, single family dwellings, 1 unit. We do have a lot of options for 2 to 4 units as well. That's been pretty consistent for the last several years, but I do think we're going to see even more opportunities for areas like short-term rentals. Now, we do have DSCR products right now for short-term rentals. There are some stricter requirements. A lot of times we'll want to see a historic income from a short-term rental property to help support that DSCR ratio. Oftentimes we can use technology like AirDNA and verified data from some of the rental income coming in from VRBO and Airbnb. I even see opportunities for mixed use properties and even some small commercial. And I think that's where we're going to see a little bit more activity going into next year. Now, I know the products, when they first get launched on market, what I find is that they're going to be a little bit more risk adverse, kind of a testing, kind of a feeling out process. The lenders want to make sure there's not any hurdles there. They want to offer lending products to where the demand is, but they also want to make sure that they're not going to run into any default issues down the road. So this is great news for diversifying your portfolio. But if you're relying solely on AirDNA data, for example, if you're relying solely on short-term rentals for DSCRs, you're going to have to expect that lenders are going to want stricter requirements on the DSCR side, or they're going to want to see significant historical income data. Now, I also think that there's going to be an opportunity for some more, I guess I can call it tech-driven underwriting. We're already using AI for our process, for our initial loan consults, and for our pricing, because lenders do change these products quite a bit, and oftentimes AI, depending on what you're using, might have a harder time continuing to gather that data unless you're feeding data into it. So that's one of the things we've started doing, and I see lenders doing the same exact thing. To what degree in 2026, I'm not really sure, but I do think it's going to be a stronger component for underwriting in next year and then beyond. Something that kind of resonates in the back of my head is, speed, so using technology and AI, for example, you can see the speed increase. You can see situations where lenders are going to be able to get to underwriting approvals and final approvals faster, but speed doesn't always guarantee accuracy. So I still think we're in that feeling out phase for the high-end tech-driven underwriting. But again, I think it's going to be something we're going to see a lot more of. So do expect that. And always compare your underwriting with the lender's underwriting. Now, as far as rates and products and pricing, if rates stabilize as they have been, they've gotten a little bit lower over the past few weeks, I see fixed DSCR interest rates stabilizing as well. I really don't think they're going to deviate much from what we're seeing in the marketplace. A lot of DSCR lenders, they don't really change their interest rates as often as maybe some of the conventional lenders and the government loan lenders, but they are still trending a bit above those interest rates. And they've done that for several years. Now, one factor here to keep in mind is I do think adjustable rate mortgages will become a little bit more common for the investment space. So there are loan products now that are adjustable rate mortgages for DSCR, and we're seeing a few of them start to pepper into some of our favorite lenders. While we've always had fixed 30-year options, we also have interest-only options for 30-year, which drops the payment a bit. The benefit there is if your payment drops a bit, you might be able to cash flow more, which might increase your ratio into an eligibility zone, all right? Now, in addition to 30 years, we have 40 years as well. So we have a 40-year fixed option, and we also have a 40-year interest-only option. Now, the 40 years traditionally have a higher interest rate attached to them, so keep that in mind and make sure that's part of your underwriting, but those products are out there. And I do think adjustables are going to become a more commonplace loan product offering for DSCR loans and other non-qualified mortgage products. I'd caution you here, don't let better loan terms or a more attractive loan product that creates more cash flow, don't let that trick you into over leveraging, right? It might be hard to see that until you're doing the Monday morning quarterback thing where you're realizing, actually, yeah, that interest rate is way too high, or maybe that 40-year was not a good fit. Just keep that in mind when you do your underwriting. Make sure that you have multiple exits and you have a strategy down the road for how long you're going to hold that property for, when you might want to sell it, or if there's a potential down the road to tap into some of that equity for future investment opportunities. So next up, I think market expansion is probably something that I would put up as one of the top conversation points for investors. So something I've noticed in our market here in Phoenix, but also some of the markets that we operate in more consistently, like California, Texas, and Florida, for example. A lot of those markets have been fantastic. They've been doing really well for years. They've seen good appreciation. So what happens is when you have properties that are appreciating rapidly over a series of years, those ratios get harder to attain, right? Because your purchase price becomes higher, so your ratios have to be better in order to get financing, in order to make sure you're still cash flowing on those deals. So as an example, I see a lot more opportunity and activity in markets in the Midwest. So Wisconsin, Minnesota, Michigan, North Carolina, and South Carolina are a hotbed right now. Tennessee and Kentucky, Indiana, Ohio, Illinois, some of those secondary and next level markets, there's still a lot of great opportunities. There's a lot of areas where you're still able to get brand new homes, freshly built for $300,000 or less. So a lot of times people are moving into those communities now because the cost of housing is so high, which creates an opportunity to offer rentals. Because wherever there's opportunity for people buying homes, there's going to be opportunities for people getting into rentals, especially if on the micro, those regions are experiencing good job growth and a good influx of new residents from other states. One thing about smaller markets though, the smaller you go, the more impactful things like unemployment will be, plants or mines shutting down, things like this that we've seen for several years now. And then regulatory changes also will cause a little bit of a stir. So as an example, California and Florida have seen rapidly increasing insurance rates, with a lot of insurance companies actually pulling out of those markets. For California's fires, the forest fires, they had the wildfires that they have over there. We've seen some of those in Arizona as well. And then in Florida, we see humongous increases in insurance. And the cost of those premiums, you have to factor that in. Whether you're buying a home for yourself or whether it's an investment, we still have to cover that insurance premium, and that's part of your debt service. So keep that in mind. Now, as we see more originations and more loan volume in the DSCR space, these loans get bundled and sold on the secondary market like many other loans do. And you're going to expect tighter standards, right? With tighter guidelines from those lenders. So the takeaway is investors with strong deal criteria. We have solid leases, if there's leases in place, solid underwriting, solid experience, credit score amazing. You want to present the best possible loan application now and in the future, because that will continue to serve you and get you the best loan product possible. It'll also get you the lowest interest rate compared to others that may not have those variables in place like you do. Investors with strong paperwork ultimately are going to win. And it always makes sense to keep your borrower profile solid, right? Whether it's credit score, whether it's the rent rolls or the P&Ls that you'll have with larger DSCR loan products, specifically in that 5 to 8 unit and then above category, you're going to continue to have an edge. So the next part, I'm going to talk about risks, okay? Risks that you want on your radar. So keep these things in mind. So slowing economic activity is one of the big ones. If you're going to invest in a market, make sure you know a little bit more intimately what's going on in that market, where the jobs derive from, where the growth is expanding, what parts of the towns and cities and counties that you're in. And you're going to have interest rate shock, right? So if you go with an adjustable rate, just know how that adjustable works. Does it adjust every 6 months? Does it adjust every year? How much can it adjust? And what is the maximum amount of adjustment over the life of that adjustable rate mortgage? This will amount to higher debt service costs, right? So if you adjust up on your interest rate, that increases that payment. And lastly, we do a hot and cold conversation a lot of times with borrowers that we work with regularly, where we're getting real-time feedback from really solid investors stating how they feel their market's going. And you'd be surprised. A lot of people in larger markets, they're talking about things slowing down before the media talks about things slowing down. Oftentimes the reports that come out, they might drag out 30, 60, or 90 days from when things are actually happening in the market. So you want to be as intimately familiar as possible with the markets you're investing in. Now, next up, regulatory moves. Okay, anything that changes from a regulation standpoint, whether it's a contraction of a market due to some changes in real estate property taxes, or, for example, a couple of summers ago, Phoenix changed a rule here with the rental rate. So we used to pay, I believe it was a 2.1 or 2.2% of the rental amount in tax as a rental tax. Well, they removed that. And that was kind of a boon for a lot of investors that didn't know what was going on. But there could also be a negative to that too. There could be regulatory changes. You want to make sure you're aware of those, because that will change your deal profile. And some of our investors have talked about market pullbacks, especially in secondary markets, where maybe there is a vacuum of activity for one reason or another. Be aware of those, know your market extremely well where you can, and make sure that you're not over leveraging. So overall, if I'm giving out a investor playbook, if you will, for 2026, there's a few points to consider. Number one, buy in resilient growth markets. You can use data from Bigger Pockets. You can use data from some of the federal websites. There's so many different resources out there that help you key in to what market you should be focused on if you're going to do this virtually. Stress test your deals for the debt service coverage that you're going to be signing up for, right? So know your vacancy rates, know what the rental market rates are, what's your high, what's your low. Are you targeting the middle? Are you targeting the low? Or are you targeting the high end? Or are you a little bit too aggressive? Shop multiple lenders, right? The benefit of being a broker, with our team is that we have access to quite a few lenders. We don't use them all. We have over 150 lenders that we can choose from. Realistically, we might only use maybe 10 or 12 of them, and then we'll constantly price them out against each other for you. But if you're dealing with a retail lender or a different lender, make sure you're shopping. Next up, keep reserves on hand. So reserves are always going to be a good thing. If you have a retirement account, you're going to be in good shape. Most of the reserve requirements that you'll come across, whether you're doing a DSCR loan for one deal, one property, or whether it's 4 units or maybe it's up to 8 units or greater, the more reserves you have on hand, the stronger your borrower profile. So keep the reserves on standby. Now next, this is something that we started doing several years ago, and we're glad we did it, is diversify the markets that you invest in where you can and when it makes sense. It requires a lot of resources in these markets, so you want to gain relationships and build rapport with agents, with contractors, with inspectors, and all sorts of different contractors and trades. That would be a great way to get involved with DSCR loans and start investing if you're located in a market maybe like California and some of those markets. Phoenix is a good example, even some of the markets in Florida where the price points have gone up so much that looking over in markets in the Midwest where the average price point is much lower, it gets really, really attractive, and the entry fees that you're going to put up at closing get a lot lower. Lastly, if I'm giving feedback to clients on our initial consult calls surrounding what sort of loan product fits best, whenever you can, try and target a 30-year fixed loan. There's not much that's going to happen negatively when you have a 30-year fixed DSCR loan. Traditionally, if you look back 80, 90 years, the rents always rise. There might be a few years where it bounced around a bit. There's actually less years over the last 80 years where rental rates have declined. than where appreciation has turned the other direction. If you go with interest only because this is a shorter term play and you're only going to hold this property for a few years, try and go the fixed route if you can. So overall, in closing, I think the DSCR lending arena in 2026 is going to grow. I think we're going to see origination percentages go up for these investment loans. We have just a lot of investor activity, and also the buying activity for traditional retail borrowers has kind of come down. Investors are still out there trying to find good investment products and looking for the best deals, and they'll continue to do so for the foreseeable future. So if you're disciplined and if you're conservative with your underwriting and your numbers and all your analysis that you're going to do, you're going to stay strategic with your financing, and that's key. There's tremendous opportunity out there, and if you want to keep scaling without being tied down to DTI and some of the other strict lending requirements, DSCR is still the best route to go as an investor. And while a lot of investors have been riding the wave of DSCR loans, there's no reason not to continue reviewing this product for all your transactions as an investor. And if you want to talk specifically about some of the strategies for 2026 for your investment portfolio and your business, I'm happy to help, and I'm happy to have a conversation to discuss what that scenario looks like for you. So if you have questions about DSCR loan products, you have questions about the investment loan products available to you, whether it's a DSCR product or something else for entrepreneurs like a bank statement deal or 1099 deal or some of the asset depletion or asset reserve programs that we have, you can book a call with my Calendly link, which is listed below in the description. I'd love to chat with you. I want you to win. So if you found some value in this video, hopefully you did, please like the video and drop a comment. Let me know if you have questions about the market in 2026. I'd love to answer your questions. I answer all of them personally. And subscribe. My goal is to bring out enough content and value as a resource in the mortgage and creative finance and investment space as possible to help you win and to better prepare you for the deals that you're going to come across in your investment career. So thank you so much for tuning in. I really appreciate it. Hopefully you enjoyed the video, and I will see you in the next one.